All right. Hey, good morning. Um, Welcome and thank you for joining. As always, every week I'm humbled and honored that people actually choose to call in and listen. And I know we're talking about stuff that's kind of important to everybody's bottom line and important to, especially at this time of year as we get ready to harvest and figure out where to go with all this stuff that we're bringing. So I am grateful that you're here, and I'm just going to jump right into it. Okay, so over the last, I would say 12, 15 hours, I think I've read 300 articles, maybe something. Been an insane amount, and I've just been scouring for anything that could be construed as bearish enough to support much lower corn prices. And I do not see it out there. I can't be any more blunt than that. And so price action the last week and this week are truly baffling to me. And so here is a list, and I've made a crude list. Here are the 7 things that seem to have some bearish undertones. And it's stuff that we all already know, right? Okay, we've got a giant crop coming in. You know, we've got problems in the west, and we've got this monster crop in the east, and it's going to solve all of our problems. A 26% good to excellent rating, or 30% good to excellent rating across 25% of the acres is less important than a good rating in Indiana and Illinois, right? So we've got this fear that the East is just going to make up for any bad problems we have. And basically, we just don't need North Dakota, South Dakota, or Minnesota in order to have a record yield, right? China, they're not buying. They haven't been buying corn, and they're not buying enough soybeans. Well, let's back up a minute, right? Look at what they already have on the books. It's far in excess of where they were a year ago, and they continue to have it. But as they say, the bull market's got to be fed, and you got to have daily headlines in order to feed it. So the lack of headlines is construed as bearish. You've got South American acreage, right? Hey, they're going to plant rainforest to rainforest. They're going to plant all the beans in the world, and they're going to plant all the corn in the world, and we're all good. Well, it is true that they're going to plant a big crop and that they are going to raise it. That is truth, but that's not a shock to this market either, right? It's known it. Then you've got issues like COVID and crude oil and just kind of broader demand strokes and the Fed and all these things unrelated to agriculture that tend to have kind of a bearish undertone because of the fear that they put into the marketplace, right? Everyone's terrified of another shutdown. Everyone's terrified that, the Fed is just magically going to stop inflation, or that they say inflation doesn't happen and therefore it's true, right? So there's lots of fear being driven by those 2 topics, 4 and 5, crude oil and COVID. And then 6th is the port disruptions. Okay, we know that the hurricane caused some damage, and we know that that's definitely slowed things down, right? Lots of our bushels flow through the port. I'm not going to get into specific numbers because I don't think it's really that relevant. But here's the point, is that if you're hungry and you need food, and the entire globe needs it because everyone is looking for food, if you need it, then the market's job is to get it to you. And so what we're seeing is the market kind of go through this litmus test, right? Okay, the US is down, the Gulf is down. Can we go to Brazil? Well, no, they don't have any. Can we go to South America? Anywhere. Argentina? Anywhere. Nope, they're all out. In fact, they're all importing corn, so we can't go there. Can we go to Ukraine? Well, yeah, they have a good crop, but they don't have near enough of what we need. So we're right back to, we got to get to the US. So basis levels and everything else have to adjust to push those bushels around to get them where they need to go, right? That's basis's job, is to push the bushels, the supply, to where it's needed, and by adjusting itself for freight rates and things like that. It's a very fundamental thing that's happening, and it's pushing those bushels to where they need to go so that the food can get moved to where we are. or where it's needed. So port disruptions, yeah, I think is a short-term inconvenience. Is it a long-term, like, oh my God, the sky is falling, we're never going to export again? No, I don't buy that for 10 seconds, because the supply and demand, the calories that humans need have not changed. They're still there and people need them. So all of those 6 things that I just talked about, right, come to the Friday report, which is, oh my gosh, this huge fear that the USDA is going to raise acres, yield, and they're going to lower demand. Bar chart came out with like a 184 number, a 183 number on corn yesterday. I have no idea what they're looking at there. I guess, I mean, it's anything's possible, but I just don't see it when you start to read all of the data of early stuff that's being harvested, the speed at which things are drying down. We're going from milk to black layer in like a 3-week period, without any moisture and an extreme heat. So the speed with which we're finishing this crop is really, really high. So a lot of analysts that I read and really respect are looking for maybe a bullish surprise to come. I don't think it'll come Friday for yield, but it could come in the future, because we've just simply got too many problems, right? You can't put 25% of the soybean crop and 23% of the corn crop through massive drought and stress, have good, not ideal, good conditions in the east, right? You look at the good to excellent ratings, they're below where they were on previous record crops. So you've got that issue going on in the east, and I just don't see how they're going to get there. But for what it's worth, these are the things that they're talking about. These are the 7 things that people are listing as reasons why corn might go down. So now here's your weekly chart of corn. And let's kind of back up and look at this from perspectives, okay? We know that the up move started here, really back in June. Here's the August crop report. That's when it really got going. And this is the top. So those are completely objective numbers, right? There's no wiggle room for guessing or discounting that is truth. That is the high, that is the low. What I've done here is given you a Fibonacci retracement, right? What is Fibonacci? What do we have? Well, to make it simple, we know through countless studies that have been done by mathematicians over the centuries that markets tend to move and then retrace on Fibonacci numbers, which is 38.2 and 61.8%. The most common retracement after a big impulsive move is 61.8%. So where are we? Well, we've retraced 38.2 of the entire move, right? So we've hit the first Fibonacci retracement, and we've just bounced sideways on it since May. So we retraced, we moved backwards, we've been in this triangle, which we are in jeopardy of losing, right? So if we break this this low, and then this low is your real one, this $5.25 number. You break these 2 lows, we move to a new triangle. And you read anybody and they're all going to say, oh, hey, that's bearish. That means we're in a full out flop downtrend. The world is coming to an end. We are done. Well, not when you look at it this way. When you look at it as, oh, hey, we're just moving probably to a 61.8% retracement, right? Before we turn around and we've got to push things higher. Now, we've talked the last 6 weeks about rationing, and a move higher up out of this triangle, certainly above the high, is a rationing move. And we've talked about the significance of that, because rationing is an assassination, right? You have to go put somebody out of business and make their business uneconomic by raising prices so high that they stop buying corn. So that is a rationing move. And we know that that's violent, and we know that they happen very swiftly. So we've talked about this for several weeks, that the market doesn't want to do that unless it has no other choice. And so you look at those 7 factors we put up, And those are all reasons for it not to ration, right? If you have a 15 billion bushel crop and South America is going to plant a massive crop, and then all we got to do is buy time to get to that second harvest, and we're going to all be good. That's pretty good logic, really, right? It makes sense. So the market hasn't needed to explode and start to move higher. So we see that manifested in price action as working itself lower. I think that's why we haven't exploded. If I can simplify everything down, it's because the market hasn't perceived the urgency that we must go take somebody out of the game in order to ration corn. I think that's why we're doing what we're doing. Don't confuse that with we've got plenty of supply, we got to go back to a full carry market and we're going to start trading back down to 350 corn. Right? That's not the same thing. Corn is still tight and still is supportive of higher values. We're just not to the point where we have to ration yet. But what could change that? Well, the realization that our crop is somewhere below 174, right? That's where the USDA is at. If it starts to creep down to 172, 170, I'm starting to read some 168s out there. If this crop is below 175, 174, 173, and the demand is real and it hasn't shifted away, guys, we have a 600 million bushel or less carryout. That is rationing. We've got to go higher, and it's going to happen really, really quick. So where do we need to be on corn? Well, I don't want to ride this all the way down to 463, right? I don't want to ride a long futures contract all the way down there. That doesn't sound like any fun. But I also don't want to take ourselves out of the game because I don't think you're going to be fast enough to really get back in. So where we are is a pretty good spot, which is 70% sold, kind of from this lower half of this range, with calls on right here at 530 and 550. That's where we're at. So we've got long ownership above and we've got futures below. So if we do move down here, here's what we're going to do. If we move lower, we're going to lift the futures and replace them with an at the money put. And then we're going to move these calls down and out to March. Because if we do hold here and start to rally back on up, that's going to be a very powerful move if we get into October, November, and we find out that the yield isn't what the USDA thought it was, and definitely not what bar chart thought it was, right? So and if that never materializes, then hey, great, we're short futures, we're good. We hit the 61.8%, we lift them, we still have puts below it, we'll be fine there, right? Look at the daily chart of corn. If you, hold on, okay. So here's your daily chart of corn. This is that 460 level that we've just highlighted on the weekly, okay? This is the 61.8% retracement level right here. This is the gap that's been open. And if you read a lot of people, you'll say, hey, the gap gets filled, we've got to come down and fill it. Well, it can come down and fill this gap, hit the 61.8% retracement. It can do it quickly and then come right back up into this range, right? Don't take that possibility off the table. Are we just going to chop all the way down here and go to 380? I don't think so. I don't know. I really just don't see that out there on anything that I've read. But if we did, that strategy I just put out works perfect for you, right? Because you're short futures, you replace it with a put, you're still good. You're still in good shape when you do it that way. All right, let's look at beans. Beans are kind of in the same boat, but I want to point out one thing. Let me get you to the weekly chart here on beans. Soybeans haven't even retraced 38.2% of their move. Corn's trading below its 38.2, looking and threatening like it might break on lower, right? Beans haven't even done that. And what that would typically mean is that the underlying trend, the strength of the move is so powerful it can't even get support to get lower. So when you look at beans in the context of, oh wow, we sold from $14.79 all the way down to $12.39, that's a huge move. That's $2.40. You think, wow, that's really significant. And it's true, it felt really horrible. But when you look at it from a broader perspective, you realize we haven't even retraced 38.2%. We haven't even hit a Fibonacci target yet. And yet we're still struggling to find any downside momentum whatsoever. And I think that's because the bean situation is dire, right? You've got a very, very tight carryout, even with a huge yield. You've got no evidence that demand is subsiding. You've got no evidence that that China is not going to buy. You've got no evidence that we've solved the supply problem. And so, and you look at some of the things going on in the bean oil market, some of the macros here are providing underpinning support for beans, and even a trade down to 12.29 just hits that first target, and I think will be really well supported. So will we break and can we go lower? I don't know, probably. I mean, we definitely can. Does it change my mind that we still got to go higher? No, not for 1 second, because all that would do is set up a nice 38.2% buy opportunity, and something you got to look at. We're still above the weekly clouds. We're still trading above where we were 26 weeks ago. Things look pretty darn good from a soybean perspective. I know it's uncomfortable. I know it's not fun to kind of sit through big down moves, but keep it in context of the historical significance of the move that we've got. I don't think you solve this problem in one growing season and just trade down forever there without a better opportunity to do something different. So I think patience is the key on soybeans. All right, let's talk about wheat. Wheat looks really, really good, everybody. I think wheat is the one to own, to be honest. I think it's really strong, and I think it can really explode. Why? Well, you look at the fundamentals of Minneapolis wheat, you look at Chicago, you look at the world balance sheets and Russia. They've all been contracting. You look at some of the, we had a big wheat sale yesterday that was kind of unusual and uncommon. So people are getting its attention. And then last but not least, wheat is the crop that I think will first recognize true inflation when it happens, and it's got to go higher. So wheat looks really, really good. I don't see anything negative here except for corn. And I think this is the third week we've said this. Wheat looks like it should explode. If corn, I don't really see wheat exploding higher and corn dropping 60, 70 cents. I don't think that those two things are going to happen at the same time. I mean, they can, anything's possible, but that doesn't seem logical to me. So corn could act as a lid on wheat. But certainly if corn were to find support in this $5 level and turn back higher, because we start getting lower yield reports once the combines start rolling, something like that, then I think wheat could just go vertical if corn really turned its head too. So really like wheat. Still like all these markets, even though we're temporarily uncomfortable sitting through the corn decline. But I think keep it in context of what's happening and scour for bearish information, because I just have not been able to find it and have not been able to see anything that is really compelling or really long lasting. Okay, that is 18 minutes. I threw a lot of information there. If you guys want to digest it, or if you have that nugget that is like, oh yeah, we're super bearish and here's why, tell me. I'm all ears. I would love to understand that that argument that says, hey, we've got to go lower on all these grains because of X. I'm all ears and would love to hear it. So remember, there's always risk in trading futures and options, and you should only do so in light of your own financial condition. I hope you guys have a great week, and I will talk to you next Wednesday.